Welcome to the Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Today's podcast is sponsored by the ride-sharing app Lyft. While I only live about 2 miles from work, my favorite means of getting around traffic-clogged Los Angeles is to use the various ride-sharing apps, and Lyft is my favorite. Today, if you go to lyft.com/invite/Meb, you get a free $50 credit to your first rides. Again, that's lyft.com/invite/Meb. Welcome, podcast listeners. Today, we have a really fun episode. We're calling this $17 million Fintech Ideas. After a long string of interviews, we got Jeff back in the studio. Welcome, Jeff.
Hey, what's happening?
This is going to be a lot of fun today. We're going to go back and forth and talk about a lot of my terrible ideas, many of which we published in the past, so we'll be updating them, but a lot of new ideas too. So hopefully, if you listen to this and start a new business, give us a 10% cut one day. What do you know? You just want to jump right in? We want to talk about anything and get started?
No. I mean, let's add a little context before we jump right in. First of all, give us a baby update. How is Tony Huge?
Super easy. It's been great.
Wait, by the way, do you want to explain the etymology of Tony Huge? For
his name is Anton Hugo, which he didn't have for the first 5 days of his life. I was holding out for, of course, Meb or Mebin. And then Gunnar.
Should have been Mebson.
Yeah, but we have a pretty funny piece of paper from the hospital that has about a dozen names crossed out, circled. Jackie didn't approve on any of them, really. So we eventually settled on it. Love it. Looks just like it. We had some other names, but once he came out, he kind of was like, he doesn't look like that. But Gunnar was sad. It was sad when I had to cross off.
Well, I'm curious if...
Maybe next child.
I'm curious if having a kid has changed your perspective on anything, life, money, work-life balance. You know, you hear about new fathers who suddenly
I drink
have
a lot
epiphany.
more whiskey. I'm just kidding. No, it's been great. No, it's been great. I have 7 nieces and nephews, so I've seen this kind of story play out before, but it's been great.
All right. Well, anything else on
your
your
first
end?
night, however, I was like, why did I do this? This is the worst night of my life. What did I just do? After that, it's been fine.
Just one night? That's
Just
all you've had?
The first night was so bad. Changed like 10 diapers. It was like black and yellow. Every father in this and mother can sympathize. But yeah, first night was tough.
If you've only struggled with one night, I think you're way ahead of the game.
Knock on wood. Let me knock on wood.
Parents.
There. Okay.
All right. Well, why don't we jump in? But, give us a little bit more background here on what we're doing today. So it's going to be, is it 17 or 16?
17. So
you sure?
We may add some more. We'll see if we can get up to 20. Over the past 5 years, maybe even longer, we had opined on a lot of fintech space. And we did a series of posts called $1 Million Fintech Ideas. And a lot of these were, we could call them terrible fintech ideas. So you may think these are awful. We just thought they were great. And we then updated it, and said, hey, here's some that have been done. Here's some that haven't been done. And so we'll kind of go through the list of one of the ones we mentioned before and then add a whole bunch of new ones. I just think it'll be a lot of fun because it sparks a lot of curiosity and brainstorming. And maybe people listening to this say, I would love to run with that, or maybe people say this is terrible. So we'll see.
All right, so you're just giving these away for free. If anybody has the interest, they'll just run with it.
The general theme of almost all of these is, I wish someone was doing this. I would probably pay for this. I either don't have time or don't have the expertise or the interest in doing a lot of these, but it's something I would pay for. That's usually the genesis of me looking around and saying, man, I wish I had this resource. I don't. I wish someone would do it.
All right. Well, if somebody was interested in running this, but they wanted to be partnering with you, would you be willing to sort of have a partnership if they did the heavy lifting?
Of course. Email Jeff. I would love jr@cambriainvestments.com or feedback at the Faber
You've got
Show.
enough on my plate right now.
No, we would love to. That's a great idea.
All right. Well, let me quickly backtrack on that idea.
Yeah, I mean, many of these I would even fund. I mean, depending, it's the right people, but it all comes down to the people, and this is probably a good starting point where the biggest challenge with people looking for jobs or starting companies, but also with their career in general, it comes back and think about how they spend their time and how they approach things. We get resumes every day, right? Mm-hmm. I get one every single day, and the way that people go about getting a job 99% of the time is 180 degrees the wrong way. Let me explain this because I think it's important. And I was guilty of this for the vast majority, of my 20s, vast majority of my life. And here's the way that most people can go about getting a job. And I actually printed this out. This is an actual email. I will make this anonymous to protect the innocent. But here's a typical email I get. Subject line, research analyst / consultant. Dear Mebin, I'm contacting you to see whether you would be interested in my profile. I'm looking for a reliable person to take my career to the next level and from whom I can learn. Then it goes on from there for like 10 more paragraphs. Okay, this is the exact wrong way to get a job. And I think most people would know that. They should be like, well, at least maybe I'll personalize or whatever. But the way that most people go about getting a job, and this applies also to people mid-career, we'll talk about that in a second, is they're making a lot of asks. Okay, so let's look at this email. First ask. They're asking me and or our team to read the email. Okay? So take time out of your day and read this email. 2, they're then asking, so are you interested in my profile? 2, they're asking you to take time to read their resume. 3rd, then they're asking time to set up a call. So that's another half an hour, then having the call. And then the ask is, I want you to take my career to a new level. And I want to learn from you. So that's like 6 different asks, right? Mm-hmm. None of which remotely is that person offering anything of value whatsoever. So this one usually goes into the trash can immediately, okay? And that's the problem with 99% of the way that people apply for jobs is they think, they're Miss Brazil in Miss Universe contest where they're like, hey, you need to pick me. And that's why no one almost ever gets responses or jobs. I mean, the way that, and you may not remember this, but the way that a lot of people, the correct way to do it is, let me demonstrate my value. Okay. Yep. Let me make, an Epstein from the Cubs had a great interview the other day where he said, and this applies more to mid-career, but it's the same concept. He goes, if you want to get better at your job or move up, go up to your boss or go to the people you work with and say, what is the worst 20% of your job that you hate doing, that you don't want to do? Because I'll do that. And so all of a sudden you learn, so you get to do part of their job, which is someone above you, but also you're taking off their plate a bunch of terrible stuff. Same thing when applying for a job. So here's how I would approach it. So first, let's say I was emailing it. I'd say, Dear Meb, first, just want to say, love your research. I've read all your books. I've read all the white papers. I've read every single blog post, and I've listened to every single podcast. Okay? 1, so they've made an effort. And this doesn't apply to me. It applies to anyone. If you're going to apply for a job, you need to do at least your homework. You can't just start off by saying, it's a totally anonymous email. We're like, hey, are you interested in me? Okay?
Well, let me stop you there, because implicit upon what you're saying is a fundamental sort of paradigm shift in the attitude of the applicant. I understand the plight of the applicant because you're out there trying to find something, you're throwing spaghetti at the wall, but that's not going to get you anywhere. If you truly want to get the hire, it takes the time and the energy and the research to actually, number one, know what you want to do. Narrow down the universe to those few companies or opportunities that truly fit what you want, and then put in the time to actually do the background work to understand where you could add value, what they're doing, what the company wants to do, where they're going.
I agree with all of that, except the know where you're going. Like even if you're coming out of college and you don't know what you want to do, but you decide to select an industry or a company, do the homework.
To the extent you
Correct.
know where you're going.
Correct.
Yeah.
So, if you're looking into something, do the homework, do the homework on all the people you're going to interview with, read as much as you can about them. I mean, we've written articles about this on the blog. We'll link to them, called something like "How to Get a Hedge Fund Job," and it's 5 years ago. Similar things, and one of the, I remember an old Kramer article. He was like, if I was going to do a hedge fund interview, I would show up an hour early. I would buy Krispy Kremes for the office. I'd be the first person there. I would, all these things. And we used to joke our favorite unclaimed.org idea, where people get to search for unclaimed assets. I say I would show up at the interview. I would search every single person in the office, see if the government owes them money, and then by the end of the interview say, hey, look, just, I don't want you to think this is creepy, but just so you know, I did this extra work, and oh, by the way, the government owes your office $15,000. So already I'm kind of net neutral on you hiring me. So you kind of should hire me. I just saved you $15,000. Anyway, but here's what I would say. I'd say, hey, look, I've done my homework. I've read your stuff. I mean, that's just bare bottom. And then say, look, here's how I could be of value. Here's the things that I could do for you. So, hey, I read this. So maybe if they're looking for a research post, they say, look, I read this research post of yours. Or I said, hey, have you ever thought about this? And why don't I work on this research project for you? Or, hey, Meb, I saw you talked about one of these $17 million fintech ideas. Why don't I run with it? And so we'll use one as a case study, which is an idea that we just published recently on the blog called $160,000 to get an MBA or get paid to get a master's in investing. And so this we'll call this our first one, which is essentially an idea that we struggle with all the time, which is news and research curation. So a couple of years ago, we started one of our $1 million fintech ideas, which is I struggle with needle in the haystack as far as investment research. So much out there. Every day I get dozens, if not hundreds of pieces from Morgan Stanley and Goldman Sachs and newsletters and tweets and everything about various just research process. And very little of it is actually, actionable or useful. And so the challenge of winnowing that down. And so for the longest time, I'd say, man, I would love to pay someone to curate Twitter for the best possible tweets or to curate investment research. So eventually we just did it on our own, and we have a lot of subscribers now because they find a lot of value in that service because it saves them time. The idea farm. So that's an example of one. But then we started tweeting a few months ago, and I said, look, there's a whole new area, these podcasts. And so when we got started, we weren't one of the first, but we were earlier. Ritholtz and a few other were doing them. And now there's probably 24 good finance investing startup podcasts, right? So let's say there's 30. Each one puts out one per week. Some put out more, some less. But let's say one per week is the standard. And they're an hour long, usually, right? That's 30 hours a week. Who has 30 hours a week to listen to all those? Maybe 10 of them or 5 are exceptional, 10 are good, and maybe 20 are just average, poor, or terrible. Right.
The challenge, though, is even in the average or terrible ones, there could be a great little section.
Yeah. And so you could have one that's absolutely awful for an hour and a half. And I actually have FOMO while listening to many because, a lot of times it'll be a great guest, world-renowned guest. And I just sit there, just nails on a chalkboard. It's terrible. And then there's 5 minutes at the end that's just a total gold mine. Right. And so, but that's the problem. Who has 30 hours a week to listen? Even if you listen at 2x speed, which I do. By the way, I saw a new app came out that now lets you do 3x. I'm not quite there yet, but 2x. So even if you're spending 15 hours a week, I mean, that's a ton of time, and you're wasting half of that time, at least. So we were tweeting. We said, hey, look, I would love for someone to curate the podcast and just send me an update once a week, top 5. Here's the top 5 investing ones. And also maybe here's the best clips from all of them, mashed into one. And, we got dozens of responses on Twitter where people were like, I love that idea. A lot of famous people, investors were like, hey, I would help fund that. Totally, me too. And so I said, look, tell you what, why don't we do it on our own? And this, we being Jeff and I and the team here, said, so we announced this on the blog, and we'll put a link in the show notes. And we said, look, we're going to hire a handful of people. This could be as few as 1, as many as maybe 5. But the way that we're going to see if those people are any good is we'll do a 3-month trial period. And so the offer is this, and we'll have a template that we'll put on the people that are interesting. So if you're interested in this, for example, again, send an email to jr@cambriainvestments.com. But essentially, you'll listen to the podcast each week. You'll rank them 1 to 10. You'll write down any of the top moments, almost like a Sports Center or Talk Soup for, is it Talk Soup, the e-show?
Yeah.
Is that still around?
I think it's off now.
But basically, it's just like a highlight reel of the best parts of these podcasts. And so the people that so we'll do this for 3 months. And at the end of 3 months, we'll hire those people that have demonstrated to be excellent at this, fully paid position.
Potentially, if we're getting the quality we want, just as a disclaimer.
Assuming there'll be at least, we've had like 30 people respond already, and it's only been up for an hour. So and there's two ways to look at this. One was, hey, why not crowdsource it? And the problem is, most of these sites don't let you rate episodes. Apple's terrible at it. I think there's a couple sites that let you, but even then, like you said, the episode could be a 1 star out of 5, but have some great moments. So we're going to pay people to do it just for our own personal use. To the extent that we, build something that we think the community at large will find of interest, we'll share it with the community, or build something out of it. But this is literally for my own use. I mean, think about it for example. Let's say I value my time at $100 an hour, right? What is that yearly? I'm trying to think. That's 200 grand. All right, that's way more than I'm worth, but we'll call it $100 an hour. The average advisor on here probably makes 300 grand. You high net worth advisors out there. But let's say you value your time at $100 an hour, and half the podcasts are shit. So right there, if we just eliminated half of the podcasts, I mean, there's nothing better than listening to a good podcast. There's nothing worse than listening to a worse. That right there saves 25 grand worth of your time per year. It's something that we're willing to pay for just for our own internal use. Maybe we'll share with the community. But so here's an example of kind of the original tweet is like, I would hire an intern to do this, curate the podcast, and then I got dozens of people like, me too, I would love to do this. Like, I let me submit. 0 emails of people actually willing to make the effort, right? Going back to the whole conversation of be of value, be of effort. So we're doing it kind of as a contest. 3 months. And Jeff will send the info to the people that are interested, where you listen to the podcasts, you rate them, add some notes. If you make it through month 1, we'll give you a free Idea Farm subscription. So that right there is $400, excuse me. If you make it into month 3 and you get selected, we'll pay you going forward. So the worst case scenario is you've listened to a bunch of podcasts. So particularly if you're a younger investor, an MBA, college student, or even someone who's like just interested in finance, people that listen to podcasts already, what a great gig. Worst case scenario is you listen to all these great podcasts, come up with a bunch of new ideas, new investment ideas, new concepts. Best case, you get paid to do these podcasts. So first $1 million idea is essentially this podcast Talk Soup, podcast Sports Center, curated podcasting.
To clarify, though, this is the one that we're actually running with. The remaining ones are going to be more open to other people.
Well, and look, someone can steal this and run with it, but I mean, there's and this is the same problem with tweets. We used to tweet a lot about, Twitter's just a fire hose. So even if you use lists or whatever, it's just a total mess. And so I used to tweet, I said, look, I wish I could sort my tweets based on most favorited or most retweeted, and there's one website that lets you do it called Favstar or Favestar. Terribly designed, but it actually works. And so there's some apps that came out that try to do it. Nuzzle is one, but all those they do just the link. So there's a lot. So I think you need the human curation. Maybe AI gets good enough at some point, but right now it's not.
The psychology behind going with sort of the whoever ranks something the highest seems a little off to me, because I think people's tendency is to respond more when they're angry or upset, and they sort of give you a bad ranking versus...
Yeah, maybe. The good news is I think having instructions for a smaller group of people will, with very specific, hey, look, this is what we want. Maybe it's multiple grades. Maybe it's 1 to 10 on storytelling and interest. Maybe it's 1 to 10 on usefulness. We'll see. We'll figure it out, but we'll build the template, get this started. I think it's gonna be a lot of fun. But again, just this is a classic example of something that if I was applying for a job, you demonstrate your value first.
By the way, sorry, quick aside, do you want to give the quick story of that email we received recently? 2 emails. The first was, hey, Meb, love your podcast, especially love the recent Van Simmons episode. And then the second email was accidentally sent to us. It showed the template They said like, "Hey Meb, really enjoyed your bracket insert area here."
That poor guy, he got crushed on Twitter. That's the thing nowadays. Like if you make mistakes like that on social media, there was once an email. Forbes was trying to get into the blog aggregation space back in like 2008. So Forbes has all these writers ranging from Ken Fisher all the way down to me at the bottom, and so, but they sent out a mass email and didn't BCC everyone. And it was about like how much you're getting paid and all this stuff. So the vast majority of contributors got paid nothing. And it was the most amazing thread you have ever been on. And it went on for like a week where people were like, unsubscribe me. And then another one's like, why am I not getting paid? Like it's the all-time social media snafu. It was so much fun. But yeah, that was a funny one. Okay, we better start moving on. Yep. This is gonna be a 5-hour episode. So idea one, kind of curated podcast episodes. We noticed there's a cool, we've seen this for curated like book summaries as well as curated ones called Get Abstract. There was someone tweeted out a summary for podcasts in the startup space, Podcast Wire, I think, but none of them kind of rank them and sort them. Product Hunt does like top podcast of the year, but again, it's just kind of this mishmash of everything. So anyway, ours is highly focused. We'll see. It'll be fun. Email Jeff, not me.
All right,
let's move on.
Move on. Number 2, liquid alts.
This goes back to one of the very first posts we did. And again, this is something that I would literally pay someone to do. And here's the problem. So most investors, so this isn't just individual retail, but also pros, all the tens of thousands of financial advisors out there, I think have a hard time making heads and tails of all the funds that come to market. So you now have these thousands of ETFs, over 10,000 mutual funds. Like, how do you do the research on that? So there's great sites, obviously Morningstar, et cetera, write a lot about that, but particularly with the liquid alt space. So
stop real quick. Just contextualize for anybody out there. What's liquid alt?
So liquid alternatives. So it's not just your traditional buy and hold indexing like U.S. stocks or foreign stocks or bonds, but stuff like managed futures, which we've talked a lot about, or maybe currency strategies, long short equity, hedge fund like strategies, even these volatility, triple levered, who knows what funds. So the simple idea would be to write a monthly piece or quarterly, but I think it would have to be monthly. And you could do kind of a freemium model where you have a free website that kind of covers the liquid alt space specifically, and then a paid subscription that really dives deep into these funds and ideas. And our last guest would actually probably be like the perfect person to do it. Unfortunately, he's CEO of ETF.com, so Nadig, he knows more about ETFs than anyone. If you haven't listened to that episode, it was a lot of fun. But, so for example, like we get questions every single day. People are like, hey, Meb, I love your comments on managed futures. Can you tell me which funds are good and which funds are bad, or what should I do? And, we can't talk about funds. We can't make recommendations to non-clients and all this stuff. So there's a Grand Canyon-wide difference between the structures and the strategies and everything else in between. But, how much are you asking someone to do research on those thousands of funds, even to keep up? Like, it's literally my job. Like, we launch ETFs and use ETFs. I can't keep up with all the funds out there and what's going on.
I mean, that was Dave's point at the end when we were talking about his best advice for listeners. He was saying how the various sort of smaller things you discussed, the spreads, commissions, all that, that's nothing compared to what he called what's under the hood of the ETFs. You know, so
this is a big opportunity. And so of the old ideas, we'll kind of mention some of the contenders. Is anyone doing it? Has anyone approached it? Are they not? So the contenders in this space right now are Brian Haskin, who runs Daily Alts, great free website. Been trying to convince him to do a paid product for years. Morningstar has two good publications. One's called ETF Investor. The other is called like Fund Investor, so Mutual Fund Investor. And Morningstar does, I think, the best job on fund, analysis and education, but there's nothing specific to liquid alts. So they may cover liquid alts in their ETF Investor, but nothing specifically. And I actually think the right way to do it is you actually have to have like a recommended list. So say, look, we'll cover managed futures, but here's 5 that we would use or like. We'll cover long, short equity funds, but here's, some that we would use, and here's some that you should run away from no matter what. Some other people, we tried to hire Sam Lee at one point, one of my favorite writers, but he went and started his own RIA. And then, so there's not a whole lot of players out there, huge opportunity. And so, by the way, if you are a listener and you know of other sites doing these things or something that we've glossed over, shoot us an email. We'll include it in the show notes. I think this is really low-hanging fruit. So this, again, qualifies under the idea of something I would pay to subscribe to tonight.
There you go.
All right, next.
Tax harvesting.
Tax harvesting was an example of something we wrote about really before it started to become pretty widespread. So it went from an idea where I was like, hey, wouldn't it be nice if you could just type in your portfolio and have a website that would automatically send you updates on when to tax harvest it? And so tax harvesting is nothing new. I mean, it's been around for decades. Parametric was doing it in the 1990s.
Give a
tax harvesting is the concept that if you have a portfolio of ETFs or funds or stocks or whatever, that if you consistently take the losses and you wait 30 days for the wash sale rule, so sell a stock or a fund and then replace it with a near identical one, is that you're consistently taking losses and kind of lowering your tax bill because you can claim those losses against future gains and you're delaying the gains for future.
Yeah,
right?
because you're investing in similar funds, you're maintaining the same balance in your portfolio.
Yeah. And so this is a good example of a good business concept actually just became a feature. So a lot of the robo-advisors were very quick to add this. Almost all of them have it now. Wealthfront was early. Betterment does it. Parametric's been doing it since the 90s. There's a cool app website called FeeX that lets you type in, funds as well as things that's doing something similar. Richard Smith does trade stops, and there's a lot more. But it really didn't become a standalone business. It became sort of this feature, rather, which is fine and it's good. And we're glad to see it incorporated because it could be a lot of value. What's interesting is that as financial planning and investment management progresses, I mean, there is a scenario, for example, where you don't want to be doing tax harvesting. You want to be doing the opposite, where you want to be taking gains early. And one of the reasons why is, for example, if you're a very young investor with very low tax rates, you say, well, look, no, I want to be booking my gains now because I know that in 5, 10, 20 years, I'll be making orders of magnitude more, salary and my tax rate will be higher.
Right.
So eventually the tax planning software may, get that sophisticated. But right now, in general, it's a better use to delay and to harvest the nut.
Well, what's missing from what's available on the market now? Where's the real value add that you're seeing?
I don't think there is. I think it's been incorporated in enough places. It just goes back to digital advisors in general. I mean, I was talking to someone the other day, having implemented it personally as well as for our clients, I can't fathom ever going back to not having an automated digital advisor solution for my own investments for my clients. Like once people implement it, I cannot fathom anyone ever going back. It's like going from the iPhone back to the StarTech flip phone. I mean, you probably would.
I love
knowing
the flip
you,
phone.
Right?
Flip phone's amazing. Well, hold on, but if this is on the list, it's already been done. Why is it on the list?
So I said in the first 5, we're covering old ideas as an example of things, just updating them. Some have been done, some have not.
Okay.
And it also goes to show how some have been tackled, some haven't, some become features, some become entire companies.
Well, that'd be interesting if something that made the list X years ago, which has largely been done, you now see a current way to take it to the next level.
Yeah, all right.
Yeah. All right, we're done with tax harvesting?
Yep.
All right. Best Ideas newsletter.
Best Ideas newsletter was a concept that, there's a lot of these idea conferences. So Ira Sohn, there's Whitney Tilson puts on one, but there's a lot of these charity events, where you'll have Jeff Gunlock or David Einhorn will come on and say, here's my best stock idea right now. And a lot of them are for charity or whatnot. And I always said, hey man, it'd be fun to actually just have a newsletter. One, that the interview process, a lot of podcasts and newsletters have a similar flow. Tell me your background. Let's talk about research, whatever. But to actually have one, just be the entire show is just all right, what's your best idea? And let's just talk about it. And, some managers can't talk about it. Some don't want to for various reasons, but I always thought that was fun. So then there's a handful of companies and shops that have sort of been in this area. The Idea Farm, is one that we started that has a list of all these idea conferences and resources. So if you go to theideafarm.com and the resources, it'll have a lot of these. But here's a number of other people that have kind of tried to tackle this. There's a newsletter called The Manual of Ideas. that's actually really long and good. It does some conferences under this banner as well. There was one called the Private Investment Brief, which was a spin out of Santangels. SumZero, which I don't know if you're familiar with, is a buy-side community that's about sharing best ideas. It's very similar to Joel Greenblatt's Value Investing Club. Joel's you have to actually apply for, and you have to submit like 2 ideas a year to stay active. But I think they award like $5,000 a month to the best idea. And Joel Greenblatt, the guy that wrote the little book that beats the market, Columbia professor, hedge fund manager, that's a really cool website. What else? Oh, and so our buddy Wes Gray, by the way, actually wrote a paper and said, do these websites offer any value, the picks? And so he did a, Wes PhD study of SumZero and Value Investing Club and found that, yes, indeed, you could find alpha there. So it's a pretty cool idea. I mean, we're not stock pickers here, so we're not spending a lot of time there. But if I was a stock picker, value guy, or hedge funder, those would be 2 really cool resources.
Yeah, I love the idea, but you would have to keep your group somewhat small, I would think, because so much of the potential alpha is found in who's willing to put in the due diligence and find ideas that aren't common knowledge.
Well, yes and no.
If you're blasting this out, if like Gundlach or somebody's coming on and saying, my best idea is investment ABC, and all of a sudden, tens of thousands of podcast listeners hear that. I mean,
right. But so my concept for the newsletter was focus on this. So attend all the conferences, summarize them, but also do an interview series where that's the only question. That was just the theme, right? So a lot of people are attacking this in various iterations. This again is an old 5-7-year-old one. Our friends at Real Vision TV do something similar. John Malden, I don't know if it still exists, but had a publication called Just One Trade. That was under the same banner, pretty expensive, but similar idea. So again, this is an idea that we wrote about a long time ago, but a lot of people are starting to tackle, and a lot of good resources there as well.
It sort of makes me have an idea. The O'Shaughnessy podcast you had me listen to, what was it, a few days ago, he had on the guest, the Rich Barber, the guy from Canada. What I found fascinating in that was how much due diligence that guy was putting into just a handful of trades. He would be calling up...
the wealthy barber, by the way.
What did I say?
Rich.
It's
funny. That's a book that I'd actually never heard of. And it was a fun interview. So Jeff's referencing Patrick O'Shaughnessy's Invest Like the Best podcast. And it's worth listening to. You should definitely listen to. See, if you had access to our curated podcasts, you would probably know that would be one of the best interviews.
Well, I mean,
but most people haven't listened to it because they don't know. Anyway,
what if you had a small group, 5 guys, and you each committed to 6 months of due diligence on something?
No, but so that's like what you're talking about is what every hedge fund does on the planet, which is these like idea dinners where like these hedge fund managers in New York, and I've been to some of these, San Francisco, like they're like, hey, let's go get dinner, and each person pitches an idea. And so you have these small networks. I mean, that's what like literally like the entire group of Tiger funds. You pull up Tiger's funds and they all own the same stocks, different flavors. But, so these people and their networks and their methodologies, they share. But Value Investing Club as well as SumZero are closed networks. Okay. It wasn't really my idea for this. My idea was for this to be the orator or the scribe and say, look, I'm going to go just report on all of these conferences and clubs and feature these ideas. Manual of Ideas is probably closest, by the way. But also to interview people and that just be the style of the interview. And we actually thought about, I don't know if we thought about it. I thought about this on this podcast, was doing it where we just said, let's interview people and we'll say, what's your best idea? I mean, eventually it comes out somehow. Like, we'll talk to Jared Dillian and he talks about his thesis for shorting, Canadian housing stock, stuff like that. Mm-hmm. But it's never just that explicit. Maybe that'll be our 2017, rest of 2017 or 2018 question.
Yeah.
2016 was beautiful, useful, magical. 2017 has been, what's your most memorable trade? Maybe we'll just start doing what's your best idea.
I like it.
Maybe we'll start asking all 3. Anyway. All right. So someone should write that newsletter. That it doesn't quite exist. And now a word from our sponsor. Today's podcast is sponsored by FreshBooks, the best cloud-based small business accounting software. Look, I've never taken an accounting class in my life and found FreshBooks easy to navigate within the first 30 seconds. Here's an example. Say you're racing against the clock to wrap up 3 projects, prepping for a meeting later in the afternoon, all while trying to tackle a mountain of paperwork. Welcome to life as a freelancer. Challenging? Yep, but our friends at FreshBooks believe the rewards are so worth it. Look, the working world has changed. With the growth of the internet, there's never been more opportunities for the self-employed. To meet this need, FreshBooks is excited to announce the launch of an all-new version of their cloud accounting software. It's been redesigned from the ground up, custom built for exactly the way you work. Get ready for the simplest way to be more productive, organized, and most importantly, get paid quickly. The all-new FreshBooks is not only ridiculously easy to use, it's also packed full of powerful features, such as create and send professional-looking invoices in less than 30 seconds. Set up online payments with just a couple of clicks and get paid up to 4 days faster. See when your client has seen your invoice and put an end to all the guessing games. FreshBooks is offering a 30-day unrestricted free trial to my listeners. To claim it, just go to freshbooks.com/Meb and enter the Meb Faber Show in the How'd You Hear About Us section. Again, that's freshbooks.com/Meb. And now back to the show.
All right. Quant backtester.
Quant backtester was an idea where back when we wrote this in 05, 6, 7, 5 years ago, 2007, 2012, there wasn't a great resource to like go online and backtest asset allocation or tactical asset allocation models. So if you wanted to go test the permanent portfolio versus the endowment portfolio versus Ray Dalio, like you couldn't, right? So we eventually built it in Excel, and that's a feature for the idea farm we send out once a year. We update it, and you can test any asset allocation back to 1972 as well as tactical models. In the meantime, a lot of other websites have sprung up. So when we wrote our tactical asset allocation paper back in 07, a lot of people were like, hey, this is cool, but, I want to update it. Maybe I want to short. Maybe I want to do exponential. So all of these websites have now sprouted up, which is great. So Wes, our friend at Alpha Architects, who we mentioned already, has modules that do it. Ned Davis is an institutional level, certainly a boutique that's very expensive for the institutional crowd. We're clients that can do it. And there's a number of sort of individual focus. So when I say that, it's either less than $100 or probably free, or something like that. ETF Replay is a good one. Portfolio Visualizer is a free one. Extra Dash is another tactical one, as is Allocate Smartly.
Is this another idea that's you originated?
This has
years
mostly
ago?
been done.
Do you see a new tweak that could be made now that would enhance?
Well, so there have been some. So I'll name a few others, and then before we'll get into it. So Portfolio Charts is one. Quandle, Systematic Investor. Again, we'll link to these on the show. But Quantopian is an example of one that's taken the idea and run with it. So Quantopian has kind of crowdsourced algorithms where you could go in, test your algorithms on their data set, and it only goes back to like 2000 or something. So they don't have that much data, strangely. But you can easily get monthly data back to the 1920s with French Fama. It's free online, or through various resources. Global Financial Data is a paid one we use. But Quantopian basically is trying the idea of, hey, you create these algorithms, we'll crowdsource it, we'll run a fund based on it. Stevie Cohen invested in it, former SEC, now 0.72. The challenge I've always had with the crowdsource stuff is like, yes, it's potentially good to come up with ideas, but you still need someone probably to dial in the knobs. The crowdsource, which isn't what we're talking about here, but the crowdsourced investment idea is a Arlington style size graveyard of companies. I mean, there are so many companies that have tried to do crowdsourcing investing and have failed very miserably. I mean, the oldest you go back is Marketocracy. So the white hairs and no hairs that are listening, remember back to the 1990s, that was like the first version of, hey, we're going to crowdsource the theory that good stock pickers exist anywhere. They're not just Peter Lynch, but it could be a doctor in Idaho that knows these biotechs, and they'll manage their own portfolios. We'll curate the best ones, and then we'll let them run a mutual fund. I mean, that sounds actually pretty legit in theory, and they've done it, and it's done horribly. And now, so some of the commentary on that is that it comes down to who's dialing the knob. So is the underlying methodology that you're trying to find talent and then let them run these portfolios, or are you just chasing performance? And so that's the biggest concern with a lot of these algorithm, websites that lets you, some people, Covestor tried to do this in the early days. Wealthfront, many people don't know, was originally called Kaching. It was a Facebook game. Same thing that lets you track investors. Then Kaching pivoted to tracking managers, and the managers could charge up to 3%. And then eventually neither of those work, so they transformed to Wealthfront. But there's been just dozens, if not hundreds of companies that have tried that. Anyway, sorry. That was a kind of offshoot of Quantopian, and Quantopian is trying to do a crowdsourced fund, so they're actually going to manage money. But my key is that, do you have someone reasonable, and Swenson would be an example, who runs Yale's endowment, that is battle tested and knows how to put portfolios together and not just pick the best algorithms or whatever. So anyway, the Quant backtester exists in many forms. We send it out to the idea farm. There's lots of good websites. There's 3 or 4 of my favorites on here that are good, but that's an idea that for the most part exists, but there's probably still some opportunity there. We have the domain tacticalassetallocation.com. Did you know that?
I did.
So if anybody wants to run with that domain, as well as our favorite, we tweeted about the other day, one-click divorce. Please. That's not on our list of fintech ideas, but if you want to run with it, let me know. We have so many domains that, oh my God.
How many do you own now? What was your max at one point?
It's probably only like 50. But 50 times $10 or 20, whatever it costs per year, $5, $10. Anyway. All right. Where are we?
You sort of dovetailed into the next one, research boutique for crowdfund companies.
No, totally different. So this is
a little bit.
It's totally different because
disagree.
Let me explain why. So over the past few years, you've had this explosion in ability for companies to crowdfund or raise money either for accredited or non-accredited. And my comment has always been this. I said people spend more time, picking out a TV or car than certainly focusing on their investments and I see the crowdfunded space as like the worst example of that. So you could go on and put $100, $1,000, $1 million, whatever you want in a lot of these companies, and it's so easy now. And there's a lot of boutiques that let you do it. So AngelList, EquityZen, WeFunder, and there's like 10 others, right? And it's a great thing. You can invest in these companies. We've done 2 crowdfunding rounds. Ironically, we've been one of the most successful crowdfunding companies, that's actually raised money. So we've raised, I think, $3.34 million across 2 crowdfund campaigns. We did on our own because we didn't want to charge the high fees a lot of these sites do. But that's not the opportunity. The opportunity is that you go to this website and you read the abstract, say you're a doctor, again, in Idaho, and you're like, oh man, this sounds cool. $1,000, boom, put it in. Well, the problem is there's almost no information. So even if it's a late stage private company where it's secondary liquidity, so like Lyft or maybe even Uber, there's more information. You can get the revenue maybe, but for a lot of these really small ones, there's almost no information. And so I said, look, huge opportunity for someone to start a research boutique. So you would probably need 6 people, but this is a great MBA, probably semester or year-long project, thesis. You say, look, we're going to cobble together a boutique and we're going to do heavy due diligence into these companies. And I think the best way you had to do it was you'd say, all right, we're going to make a, buy, sell, hold recommendation, or make at least, one buy recommendation per month. So there's a lot of ways to do it. You've seen these syndicates sprout up on AngelList, which is people saying, hey, I think this is a good idea. You can tag along and invest with me. I'll take 15% carry. AngelList takes 5%, and you get to invest. And it's just like, it's pooled VC. But I said, instead of doing it as a syndicate, why not do it where you look at the opportunities everywhere and you do deep dives? And so people could either buy the research reports to say, hey, here's one that just came out. I want to buy the research report on it for $100 or whatever. Or it's a different service where it makes recommendations where, you put in an actual portfolio or say, these are ones you should buy, should not buy.
My impression is that when you're dealing with private companies like this, the numbers are so slim in terms of the percentages of the companies that work. So to what degree...
Well, that's the true example of value-added research.
Agreed. But if you're doing, you said deep dives, it's a lot of manpower and there's a lot of companies on these sites. So that's potentially a hell of a lot of time to do this. But even if you find great companies, is it not smarter to try to amortize your money over 100 of these things rather than just,
right,
sniping one or two?
It's 100 rather than 1,000, or it's 10
True.
rather than 100. So
Sure.
if you winnow down this list, at least get rid of all the crap. So if you're like, these are really terrible ideas. And, in some cases, like the problem with some of these sites, like AngelList, depending on the syndicates, there's like a setup fee of, I saw one the other day and it was like 20% setup fee. Usually they're only a couple percent, but you're like, already you're taking a haircut of 20% and then it's 20% performance. Like it's just, the biggest problem is that you have to do it as a private newsletter. You couldn't do it as a public-facing boutique because you can't write about these deals publicly. It runs afoul, not for you, but the sites will block you. So I tweeted once on AngelList. I was like, oh my God, look, so-and-so is raising money. And they're like, Mab, can you please take that down? It's seen as general solicitation. Maybe that'll change. So you do it as a private newsletter and private boutique. So you could charge for, coverage of individual companies, or you could charge for recommendations, which is the way I would like to see it. There's one website doing it called Early Investing, and they actually do a really good job. So we'll link to it. There's a lot of companies tackling sort of the data side of it. So there's one called Triton Research, there's one called Disruption, another called DataFox, another called CB Insights, and Mattermark. All those are kind of in the universe, of this area. But no one is actually, other than Early Investing, is doing it where they're saying, hey, look, this is what you should buy, this is what you should sell. And I think the best way to do it would be the writer of the newsletter has to be, I'm putting my own money in along with you. And maybe you can just piggyback. I mean, if we weren't doing Cambria and everything else here, this would be a really fun area because it's fascinating to me getting the information on. And yes, we're year 8 bull market, so you start to see some really crazy, awful, terrible ideas that are getting funded for crazy amounts. But there's also some really cool companies that are growing fast and hitting these new niches that I think are great investing. And so in a world, particularly where a lot of the public companies are waiting longer to go public, this is kind of a part of the asset class. If you're looking at equities, the private equity VC, that a lot of people have less exposure to. So anyway, I think it's a good opportunity.
What's the latest company you saw on one of these sites that grabbed your attention?
My two favorite sites are certainly still AngelList and Equities In. And AngelList has pivoted to this syndicate model. So it's people that bring a deal to the site and you subscribe to the syndicates, which means you just follow them, but some you can autofill and some not. And then you've seen either other innovations like Jason Kalkanis left and then just started his own because to avoid the fees. So he's like, I'll just syndicate my own deals on my own. So as far as specific names, I'm trying to remember. I love, and this is a little biased because I'm a consumer of these, I still love the subscription boxes. And I subscribe to about so 10 of those,
And tell you how many times I've come to your house and seen some random things lying out on your counter.
Our dog has learned to open cardboard boxes. I'm going to get a video and post it to the podcast because there's so many boxes come. We've taught him to open the boxes for us. But I mean, there's some good one of those. Birchbox was kind of the original one. It's an entire industry now. It's totally saturated, but it's such a great business model because to the extent you do find one that works, it's sticky money because people forget about it or they actually love it. So there's one that's based out of LA and I forget what it's called, but it's targeted just at gamers. We actually tweeted about this and they make hundreds of millions of dollars. It's unbelievable business model. So I subscribed to about a dozen of these. By the way, a great app. There's an app called Clarity Money that it's kind of like a Mint or something where you sync your accounts, but then it lets you know what all your subscriptions are so that you can cancel them. It's do you know you're paying, and this is a perfect example. It's do you know you're paying $15 a month for audible.com? I was I had no idea. How long has that been going on? So that's 2 business models already that are made. So I love those. And so there's some that I had never even heard of. I invested in a few where just the sales are increasing, they're doing better. I mean, it's just, anyway. Let's move on or we're going to be going forever.
All right. Rookeyes are reborn.
You skipped another one, which was a part of this similar idea, which is what we called syndicate podcast and newsletter. And this is kind of if that was, what number was that?
7.
So if that was 7A, this is kind of 7B, but we'll still call it 8 or whatever, or 7, whatever. This is in the same ballpark, which is, it'd be cool to have a podcast if you then interviewed all the syndicate leads and said, what are your best ideas right now? So tell me about what the syndicate you're raising. And the big problem with this one, of course, is that you can't talk about them publicly. So until the rules change, or you could do it as a private, newsletter radio show where you had on the Shark Tank, what's her name? Barbara Corcoran. She has one that actually has a ton of good deals. I think she's really, I don't know if it's her network or, the people running it, but she has a lot of really cool syndicates on there. But to have her on and say, Barbara, what's your best, one you're leading right now? Again, it probably ties in with the one prior, which is the boutique or newsletter concept because it has to be private. If you're talking about it publicly, you're going to get cited. So So I know no one doing this, but I don't know that you can. So
prior to working with you, we were actually in talks with Barbara's, I guess, lead syndicate guy, Phil Nadell. We were pursuing that idea, and didn't go anywhere, but had legs for a little while.
Cool. Got an email from him this morning.
Oh, nice. Okay. Any more on that?
No, but syndicate, by the way, the syndicates are like the all-time best deal for the syndicate leads. I mean, getting 20% carry on something for doing nothing other than just raising the capital for it, I mean, that is a awesome business model.
I sense that's what you would be doing if you were not running Cambria.
No, but I think it's way too much. I mean, that's why we did the crowdfund rounds on our own and didn't charge any carry. It's because, I mean, that carry is a huge
a lot of money
drag. But I mean, look, if you can deliver great deals and consistent, then it's a great job.
Feels very much like 2 and 20.
But it's more than 2 and 20, probably. All right, keep going.
Rukeyser Reborn.
This is one that's actually kind of funny because Louis Rukeyser was, the old school Wall Street Week, and he used to do it. I think it was every Friday. So he would have on like Marty Zweig and all these just great long form conversations. So the whole point of this idea was that we need more long form conversation. We need less CNBC, Fox, Octabox, where there's 9 people shouting at each other, and more time for people to thoughtfully converse. Since this has come out, there's a couple things that have happened. One is that podcasts have blown up. So you've had this huge launch of all these podcasts, which didn't exist when we wrote this. Ironically, Wall Street Week got relaunched by Scaramucci. So he actually bought it and then relaunched it. I haven't watched a single one, so I don't know if it's doing well or not, and how they're syndicating or where they're publishing it. And then I think the best version, honestly, is and for full disclosure, they've been a sponsor of the podcast, but Real Vision, I think, is doing a really good job. I think the first iteration, and this is long form video. We did an interview from the Caymans, but it's like an hour, high quality video. They have an app, so Real Vision TV, with some of the best minds out there. So they got Kyle Bass, all these guys talking, interviewing with each other. The first iteration of the site was the interface wasn't well built, but I think the second iteration is. So I think they got a big lead, as well as a million podcasts. I mean, we published on Twitter a list of about 20 podcasts we really liked the other day, but that's grown from 2 or 3 to now. Again, this category for Rukeyser Reborn has been so successful. It's now generated the new first idea, which was we need to curate this idea.
Right.
There's so much good stuff that we need to curate it.
Next one, The Street 2.0.
This is one of my favorite ideas. And this idea doesn't just apply to finance and investing.
Back up, what was The Street 1.0 for people who aren't sure?
It's the current thestreet.com.
Which is?
A website.
That?
Oh, if you haven't heard of thestreet.com, it's been around forever. Jim Cramer helped start it. And it's funny because the list of writers that have been either came out of the street or wrote for the street at some point, it's like a who's who of the investing space, particularly the early writers. So I wrote there for about a year until I got fired, which is a great story.
I don't know that story.
And it's funny because thestreet.com was so innovative in many things. So they had the free version, which was The Street. They have the paid version, which was called Real Money. And they had a columnist conversation, which essentially was an early version of Twitter. So you would have the columnists able to interact with each other, and they would post. Now you had to go through this arcane, terrible, something that was like DOS 95 version of WordPress, where you actually had to code in. It was really, really bad. Anyway, so columnist conversation, you could probably go search all my old articles on there. I don't know if they purged them, but I would cite mine. So I would say source, and at one point which is, by the way, the standard way, correct way of writing and research, you source your sources. They eventually no, you're linking back to your own sites and other sites too much. We can't have that. And I was like, well, that's literally the best practices, whatever. But it was funny because a couple years later, the guys that fired me, they're like, hey, Matt, would you like to join our new site? I'm like, do you guys remember how this ended? Anyway, the street has been so poorly managed for the past 2 decades. The private equity companies got involved, and it consistently trades at cash, value. And the problem is it makes a ton of revenue, but it then spends all of it. And here's the idea. So the idea was what's the biggest expense for a site like The Street or a newly successful competitor, Business Insider? The biggest expense is headcount. So Business Insider probably has hundreds of journalists. You think about it and you say, all right, well, look, we live in a world where there's a lot of, and there's the kind of similar site, which is Seeking Alpha, which has I forget what it is, 40,000 contributors or something, you know? So it's the exact ass opposite of that idea. But you say, all right, well, we already know, we could identify, I don't know, 10 to 50, well, let's call it 10 to 20 of the best investment writers out there. So we could just go down the list, Ritholtz and Josh Brown and all these guys, right? Most people they may not agree, but you could identify with a lot of them and say, why not get the top 10 or 20 together, form a website, almost like a co-op, and either republish the articles, but have them be heavily branded in, with the authors. Because you have a site like Seeking Alpha, which has 40,000 contributors, which it's like Yahoo message boards times 1,000. It's just that the quality is so poor. It's just a ginormous fire hose. And you can see a theme on a lot of my ideas, which is curation and trying to find the signal from the noise. So give me the few gems. So if you could edit that site and republish or convince any of the writers to only publish there, all of a sudden you have the best of the best. You have the best writers. You eliminate the number one expense, which is headcount. And so all of a sudden you have a site with almost zero startup costs and already the people that control all the traffic.
You basically are replicating Wirecutter for various industries that you like.
Well, and the cool part about this is then you could take it to any demographic. You're like, all right, you care about microbrew. So here's how the world's changed though. When we wrote this, I still used to go to individual writers' blogs. I would go to Barry's blog. I would go to all these, various people's blogs. I haven't done that. I can't even remember the last time I did that. I'll see someone will mention a post or an article on Twitter, or, I'll get it through the grapevine or through one of these apps. Remember RSS feeds, right? Mm-hmm. Where people would curate. But if you could have everything in one place where they had the best writers, that would be a great resource. And so if you do the valuation on Seeking Alpha or The Street or Business Insider, and we did an article on the blog called "How Much Content Has Seeking Alpha Gotten for Free?" So meaning the writer, all these poor writers post and they don't get paid for it, and they get paid some tiny fee now, I think. But it's the last time we checked, it was 50 million or 100 million. I think it was 120 million dollars. So the site gets all the benefit, but the writers get none. But we live in a world now, and you see this changing with the publishing industry, you see it changing with podcasts and everything, where the content creators are able, and YouTube especially, are able to monetize their writing. And so I said, look, we'll have a site, we'll get the best writers together, we'll run it for them. Again, going back to Forbes, how they did it 10 years ago, where there's your name as a tiny byline at the end. So the world's changing to where the content creators should own their content and really monetize it. So basically it's thinking of a platform for that. But then that applies to everything. You're interested in microbrewing. Let's get the 10 best guys writing about brewing beer. If you're interested in, polo, horse, the playing polo, then we could do the same thing. And so you could then take it to almost any vertical if you wanted to. I just said we should do it in investing because we know a lot of the people. And I actually took it to all the bloggers and guys and said, what do you think about this idea? I'm going to build a site. We should have you run it, Jeff. Build a site. We'll fund it with $1 million. And Blogger will give you equity and, I don't know, half the revenue from the pages that you have content. And by the way, we'll let you use our advertising network if you want, as well as have all of your offerings, available to the public, et cetera, et cetera. Mm-hmm. Of course they're going to say yes. Why would you not? Anyway. So they were all on board, but we got enough on our plate to where it's not a priority for us, but I think it's an awesome idea.
Yeah, well, that's the riches are in the niches. That's the saying goes,
God, I've never heard that.
That's a good one.
Who is it?
Oh, God, I don't know where I picked
Yogi
that up.
Berra.
All right, we done with this?
Yeah, let's go on.
Hedge fund letters.
And the original name for that, when we first wrote about it in I don't even know when, was called Bloggerator for blog aggregator. And I even got some cool logo designs off 99 Designs. We had a new name for it the other day. I can't remember what it was. Anyway, if you got a good name for that site, let me know.
Hedge fund letters.
What number are we up to?
10.
God, barely halfway. Hedge fund letters is a simple one. It's a website we had started anonymously years ago and then shut down because it was being a headache. And the concept was, I love reading old hedge fund letters, whether it's from Einhorn or Soros or Julian Robertson. And it's such a shame that there's not a Wikipedia or resource for these somewhere. And, the world's gotten a lot more transparent. Back in the early days, hedge funds were so secretive and they didn't want people reading their stuff, but the world's really changed. And so my idea was, let's start a website. We'll archive and link to all these old letters. Not only that, the 2.0 version was we'll reach out to all these hedge funds and say, hey, here you can claim your profile here and it'd be verified. And if you want to post all your old letters, I'm sure it'll be seen as an amazing thing by the community and you'll get, traffic and interest. I still think it's a great idea. And I think it used to get a ton of traffic, by the way, the website, because no one is writing about this long tail of hedge funds. You Google some of these hedge funds, even still, the number one result is hedge fund letters because there's just not that much content. So I think that would be a really fun area. I don't know anyone that's archiving the letters still.
Well, listeners, if you hear this and you actually look up hedgefundletters.com, we did actually put that site together. So there's something up there. If you can go there and sort of see the idea and
news to me
and a crew that's up there.
Okay, I know. I just didn't know there's anything there.
Yeah,
so apologies for the content, by the way. But I think it's a good idea. It's a simple one. And it's not one that's hard. So if you're a young guy or someone who just loves hedge funds, that's probably $1 million idea. You could probably get $1 million in revenue from that site.
Sort of the second evolution of that, which ties into your Wirecutter idea, would be to read all of the old hedge fund letters and scrap out the stuff that's relevant only to say what was happening in the market 10 years ago. You find the pithy nuggets of wisdom that are timeless. So you find something that has a learning lesson and you present that versus having to trudge through, countless pages of stuff that's no longer applicable.
Yeah.
All right. Newsletter sampler.
This is one that we kind of built, and then it's kind of, again, just sitting there. The concept was, for those who aren't familiar, Mark Holbert, one of the best writers out there for the longest time, wrote an article, newsletters. I'm blanking on what it's called, but
Holbert's Digest.
Yes, Holbert Digest, where he would review and track the performance of all the investment newsletters. And not surprisingly, many of them weren't very good, but there's a handful that have been consistently great, etc. So it provided two services. It not only shone some disinfectant light on the newsletter space, which is notoriously kind of snake oily, but also it had a way of tracking some of the best ones. And there were some good ones and great research. And we subscribed to a handful of professional as well as broad-based newsletters today. So my concept was it'd be nice to and so Holbert stopped publishing that about a year or two ago, which is a crying shame. It really is terrible. And so the first concept was let's at least just have a white pages of the investment newsletter space. So you want to go to somewhere and learn about all the investment newsletters, here you go. Second would be you could reach out to all the newsletters and say, hey, send us a sample. We'll post them all on the website. That way people can look at these newsletters and get a lot more information. It's all in one place. Lastly was, hey, you could do a paid or freemium subscription where you send out once a week a different newsletter. So that way people get an exposure. You charge $100 a year. Say, hey, and the newsletters like it because they get potential new customers and signups, and the investors like it because they get a different newsletter every week. That's a cool idea. Again, that's something that I would like it. Even the crappy ones, it'd be fun to flip through.
Well, not only that, but even just the tiniest bit of information in this space would help, because there are literally thousands upon thousands of newsletters out there, and it's hard to distinguish, all right, which one has 200,000 subscribers and it's legit and it's been around for a while versus who's doing this in a basement and has 20 followers, because they all have websites and you can't really tell. There's so little information.
Yeah.
So,
and there's some really amazing ones where every time I get a newsletter, it's for me, it's like Christmas Eve, Christmas morning, where they're so good and packed with information. I mean, we've mentioned Jared Dillion's, by the way, who just started a podcast, and his newsletter is called The Daily Dirt Nap. I read it every day, and he's a great part of it's because he's a great writer and he's entertaining, he's been right, but it's a fun read. So I'm sure there's a lot out there that I don't even know about. that I'd like to read. I feel the same way about Leuthold's Green Book, but that's institutional, and I don't think you could pay for it if you wanted to. Maybe you could. Anyway, so this is a website we actually have up. It's a skeleton website. If you want to run with this, please reach out to Jeff. This is something that I think is we're gonna have to hire another Jeff.
This sounds awful.
If you want to take over and be Jeff's assistant, also email Jeff. If you would like pizza from Domino's on Saturday night, email Jeff. All right, so that's a cool one. Check it out. Move on.
Tactical robo-advisor.
Yeah, I mean, this is a good example. We've been writing about the robo-advisor space ever really since it got started, and it's actually played out. Look, we'll be the first to admit mistakes and dumb predictions we've made, but the robo-advisor space has played out really exactly like we predicted, which was there's a lot of innovation, but the incumbents have an incredibly unfair advantage that are the issuers that have their own funds because they can launch at a much lower fee and also have the scale of their current client base. So that's what's played out. Vanguard and Schwab were late to the game, but Vanguard, I think, is now at like $70 billion. They raised more this past quarter, I think, than all the other robos combined. And then, Schwab's number 2, and then Betterment and Wealthfront, Betterment, and then Personal Capital. So that's really the top 5.
You think this is going to squeeze out anybody who doesn't have their own in the future?
I think everyone will have one, no matter what. So CREF, Morgan Stanley, they've all announced digital offerings. And again, we were talking about earlier, from someone who's used one, as well as clients use them, no one will ever go back. Like, it's such a better interface. Like, so we partner with Betterment on ours. I mean, clients don't pay commissions on the trades. So you go back to paying $20, $40 commissions. Why would you ever do that?
Yeah.
It's such a no-brainer. So, but there's some other things that have kind of evolved that we didn't really foresee. And part of it is that the best business model has kind of become the cyborg, which is a digital advisor paired with a human. So Vanguard's is 30 basis points, comes with an advisor. Schwab did 0, but then they also came out with a 28 basis point that comes with an advisor. Betterment pivoted to including an advisor for a higher fee.
How much is the advisor doing right now?
I mean, I don't use any of them. Granted, our buddy Steve Lockshin the other day was like telling everyone, he's like, just sign up for all of them. A lot of them don't have minimums. Like, if you're an advisor and you don't have an account at every single one of the robo-advisors, you're an idiot, because it's for most of them. Yeah, he's like, you should be doing your due diligence.
Right. See what the
competition's doing. Some have minimums. So so we didn't really foresee the cyborg being kind of the killer, app of this, meaning it's an advisor that's lower cost, but it still has a digital solution. I think Wealthfront is the only, there's a couple, but Wealthfront is the only one at scale that still hasn't added a advisor side. Mm-hmm. So, but the floor has been set. So if you're a advisory platform, digital advisor that doesn't do planning or offer, human-based element, the floor is 0. So that's been set. We've done it. Cambria's done it 0. Schwab's at 0. So if you're just doing investment management, that's now the floor. And the problem for a lot of advisors is that the floor on the advisory side is really that 30 to 50 bips. Personal Capital is higher. They're up at, I think, 80 or 90 and are still successful with $4 billion. And let's be honest here, there's still, even at $100 billion, this is meaningless compared to how much AUM, Morgan, Merrill, all these other guys have. But they should be aware and be scared, because 30 bips is now the floor, or the standard.
I'm curious, on a side note, what do you think about the role for advisors? Let me back up. You've written at length about how, over the long term, any legit global asset allocation model is going to end up in the same place down the road. They might travel different paths to get there, but if it's well diversified, they're largely going to be the same. So the actual advisor can make himself worth whatever his fee if he basically keeps his client from doing dumb stuff. So basically, if you have some ability just to sort of set your asset allocation model and then turn away from it, do you need the advisor?
So we've also commented on the robos over the years and said, look, it's going to be really hard when we have the next bear market, because you don't have that Chinese wall of someone to talk to close your account.
There's no buffer between you and
at least you could, at least if you have an advisor, you can call them and say, hey, Jim, I'm freaking out. Can you sell everything and close my account? Yeah. And they'll say, it's probably not the best idea because here's the goals. Here's what we set out to do. This is totally within the parameters, yada, yada. So the advisors are worth their weight in gold there. So that's why this digital cyborg, I think, is the best offering where you still have someone. But if it's like a call center one, or if it's just you have one in name only and you don't have a personal interaction with them, does that count? I don't know. Probably not. But people behave poorly with advisors too as well. So it's very dependent on, what's going on in the world and what the bear market looks like. In general, I think if I was an advisor today, I would say, look, I'm going to implement a digital solution and I'm going to focus like hell on estate planning and tax management. And
I was thinking there's got to be more than just the holding the hand.
And not only holding your hand, I want to meet all your children because it's only 1 in 5 accounts where the children inherit when the parents die, keep the same advisor. They move on. They do something else. They find someone they like. So I would focus all of my efforts on the other stuff. Right. Including education, as well as just being, I don't want to say concierge, but being involved in their lives and being what an advisor, kind of in my old school way of thinking about it, was meant to do. And the cool thing is if you implement a digital solution, you spend 0 time on trading and asset management.
That's become
and
commoditized,
research.
so you get to focus on the relationship side.
Now, that's a nice background for this idea because we're not even talking about the idea yet. The idea was tactical robo-advisors. So my point was, when we wrote this, and this is before this even happened, I said the sponsors and custodians will be impossible to beat here because they have their own funds. Now, if you look at, and we've done a lot of articles here, Google Betterment versus Wealthfront, I think it was Betterment versus Wealthfront versus Schwab, and Goldman too. All of these guys do the same thing, and that's not bad. They do a buy and hold, low cost, asset allocation, tax harvest. And there's some bells and whistles. Some have a little more in foreign, some maybe have commodities, some don't. But we backtested them in 1972. They all essentially do the same thing. And that's fine. But there is 0 differentiation. So if you want one of those, you should go with the cheapest one, right? And that's who will eventually win. And they're all, so like I tweeted the other day, I said, look, the top 5 robos, they're all fine. I like some better than others, but they're all fine. So this is way before we even launched one. But I said, if you had one that's different or other ideas, maybe, so TIA announced that they're doing an ESG focused ability, right? And I think Motif did the same thing. They said, all right, well, younger clients care about this, and you can screen out various investments or stocks. Great. The way, so we've done obviously the Cambridge Digital Advisor. We do Trinity portfolios, which we've talked about, at length, where it's roughly half in buy and hold allocations and half in tactical allocations, all with a tilt towards momentum and trend and value. That's the best way we think, we know how, and including a little bit of alts too. There's a handful of others. I don't even know how many of these still exist. Obviously West at Alpha Architects. There's one called Huygens, Huygens. I'm terrible with that name. Hedgeable and Hedgewise. I don't know if those still exist. They probably do. But meaning, you can't, even if you believed in that world, it's hard to compete with a Vanguard or a Goldman when they're charging, 0 to 30, right? So if you're going to do a robo, I said, consider doing a tactical. Anyway, we did it. So we'll see.
It makes me think of, it's a little different, but research affiliates in our knot who have the smart beta backtesting. If you could find a way to target that, sort of have bolt-on sort of asset allocation pieces.
Well, and it's funny because, so there's other offshoots. So for example, we were talking about dimensional fund advisors the other day. So DFA is a classic mutual fund shop. They only distribute through financial advisors. And so they have great funds. They're like 400 billion now, very traditional factor-based out of the French Fama world. And they have a great business model because they attract a cult-like following. You have to apply to get approved on their network. They send you through classes, and it's a good offering. But the challenge is if you're an end investor, the only way to access DFA funds is having to pay an advisor too. And some of these advisors charge 2% a year. So I said, if I was a young guy and believed in buy and hold, yada, yada, and I wanted to raise a lot of money, I said, I would become the low-cost DFA provider. I said, you know what? I'm going to do this for 30 bips. The lowest one we could find, I think, was 50. Asset Builder was one of the earliest robo-advisors, by the way. He doesn't get much press. Scott Burns' shop. who I think is now retired, but they are like 800 million maybe on DFA funds and so low cost. But most of them around like 50 bips. I'd come in, I'd say, look, I'm going to launch a DFA shop and I'm going to advertise all over the place. I'm saying, look, I am the low cost DFA option. You want DFA? Great. 25 bips. Boom. I don't do any planning, but you get DFA funds. I think that'd raise a lot of money. It would piss off a lot of people.
Well, this idea has
you'd make a lot of people angry. DFA now, by the way, sub-advises on some John Hancock ETFs. But anyway, it's
this idea has the biggest scale ability, but it also has the biggest initial seed nut you need to actually get started.
Well, you need armor from all the DFA advisors coming to murder you from disrupting their business.
When you launched your no fee fund, I won't mention it here. We're not supposed to mention the names. Were you worried about the market's reaction to you not?
Yes. Well, it's actually funny. I don't even know if you know this story, but there was definitely something amiss. Like the night or 2 nights before we launched, NYSE called us and was like, hey, like you can't launch. There's some this, that, or that. We're like, what are you talking? Like it was the most meaningless. And they're like, yeah, there's some people that were like complaining. It was like this weird, I don't do conspiracy theories, but to me, this was such a conspiracy theory. Someone didn't want, and we're still the only 0% management fee permanent fund out there. One of the lowest costs. Now, it's only like 50 million, or I think it's getting ready to be, or maybe, somewhere in the mid 40s, 50 million. So it has done nothing to disrupt the entire 2% management fee asset allocation buy and hold world, because that has almost $1 trillion. Maybe we're early. We'll see. Maybe we just haven't marketed enough. But yeah, that one definitely gets its share of critics for sure.
A little shady there.
Yeah.
All right, moving on. Free Acorns / Stash clone.
What number are we at? 13? All right, we're getting closer to the end. So Acorns and Stash, if you're not familiar, and there's a handful of these other ones, are essentially like these savings apps. So we all know that people are terrible at saving. And the best way to kind of do this is to automate it, or to have ability to take money out of your checking account or whatever, just the behavioral nudges that make savings and investing easier. So it sounds great on theory. And most of these charge, almost all of them have the same business model. They charge $1 a month and over $5,000 balance. They'll charge you 25 basis points for a portfolio to invest it plus fund fees. So same as every other robo-advisor. Sounds great, right? And so they've literally had millions of accounts sign up, been hugely successful. Problem is, in every single journalist that writes about this never gets it right. They don't do any homework. Is that they're hugely predatory. And the reason being is the average account size for a lot of these is like $30 to $100. So if you're charging $12 a year on a $30 account, that's 30% fees. On a $100 account, it's 12% fees. So, dipshit investor, just go open an account at Bank of America, or somewhere where you're not going to be paying. Now, there's other fees, of course, if you don't watch out, or just keep the money under the mattress. But, so it makes tens of millions of dollars of revenue for these savings accounts apps. So I said, look, if you're, we called it, I think one of the articles was millennials that can't do math. But I said, what happens if Vanguard or Schwab or someone, Betterment, to my knowledge, doesn't have an account minimum. Like, why wouldn't you just go sign up with one of these that are zero fee? Like, I guess it's good marketing and good branding, but eventually there'll be someone who's going to launch a clone of these totally for free. Look at Robinhood, trading brokerage. They have $0 trading, and they just got valued at, I think, $1.3 billion because they've amassed.
Much?
The what's his name? The famous Russian investor who's done a lot of the startups here, just invested around in them, but they've amassed a huge user base. So, by the way, investors, you want to trade Camber ETFs? They're free on Robinhood. Anyway, I think someone will eventually launch a clone of these for free. We consider doing it. A lot of work to build the app or to partner with someone we're not too interested in, but it's an opportunity for someone.
Account size for $3,100. That's a lot of accounts to make this sizable.
Yeah. All right. Like I said, not all these. The title of this is 17 terrible $1 million fintech ideas.
All right, keeping on the free theme, what about free ETF trading brokerage?
So the challenge I have with Robinhood is I don't really see a business model. They say they'll do they'll charge for margin lending, which is not in the investor's best interest. So we've seen with the Forex brokerages that if you build a company that is, predatory or not in your investor's best interest, it doesn't last. You have huge churn. And then, they have like a gold level, and I'm not commenting on Robinhood. I'm sure it's a great brokerage, but it's not clear to me how they'll ever make money. They have like a gold level, which lets you fund start trading even before the funds hit and do some other stuff. Early access to IPOs. I don't know. Is
that even legal?
I don't know. But my idea was that, there's all these brokerages. So for example, you can trade our funds commission free on Interactive Brokers, and Interactive Brokers is smart because they just say, hey, look, you pay the commission, what the investor would have paid, and everyone wins. So Cambria gets assets, the investor gets 0% trading costs, Interactive Brokers gets the revenue from the trading. So it's good for everyone. Anyway, the commissions have come down a ton over the past few years. I mean, if you're paying more than $5 in general, it's probably too much at this point. But we said if you could do one where it's totally free, but implement that, you could have a sustainable business model. But it kind of benefit, like everyone wins. Like there's no real downside to me. Anyway.
Yeah, I like it.
I don't want to be in the brokerage business, so run with it.
Free shares ETFs.
I love this idea. I was chatting with Venuto from Tesoro on this. So, Mike, if you're listening, apologies for publishing this idea. But we talked about it a few weeks ago on the podcast anyway. And I'm not dumb enough to do it. But essentially, a lot of people don't know this, but ETFs or mutual funds will lend out the securities in their fund to short sellers and charge a fee. And the good guys, the mutual funds like Vanguard, will then return that fee to the shareholders. So it comes out as additional yield. Well, if you have a low-cost fund, so there's a handful of ETFs, BlackRock, et cetera, that do this. Let's say the fund charges 20 basis points, so 0.2% per year. Well, they may get 50 basis points in short lending. So in effect, you're getting a fund that not only doesn't charge 20 basis points, it's a negative 30 basis point fee. So you're getting paid 30 basis points to own this fund. So not only is the fund free, you're getting paid to own it. That's just awesome. That's badass, right? Like a lot of people don't know that. So we live in a world where there's free funds already. Not my idea. My idea was, okay, target the 3 or 4 or 5 areas that are volatile. So short lending in general, you get a higher revenue on high short interest names. So usually the names in the news, whether it's Tesla or stocks that people think are expensive, that are highly shorted, people will charge 1%, 5%, 20% a year to borrow that stock. So you got to be a really confident short seller to pay 20% a year borrow cost. So you're assuming it's going to go down more than 20% the next year. So my idea was, all right, target 3 high short interest areas. So biotech, semiconductors, maybe real estate, even the Russell 2000. Launch a suite of 0% fee funds. So the most that fund can charge is 0%. You undercut, obviously, everyone. Mm-hmm. So you should gain a ton of assets. And the prospectus, you say, all right, we'll keep the first 50 basis points of short lending, and then we'll return the rest to shareholders.
What do you know about any sort of historical case studies of short lending blowing up on the investors? It's
all in the design. So they require collateral. So, for example, if we lend you our shares of Tesla, typically the short seller has to pledge whatever the amount is in cash or T-bills or something, plus like 120%. So you got a 20, and that gets mark to market nightly. And so, the custodians who manage this process take a fee for doing it. So usually for the bigger guys, it's like 80-20, 90-10 to the fund company and 10% to the custodian. And they manage it, and you can write in whatever you want. You say, look, I want to be as conservative as possible. We're only going to work with the best names. We're not working with, Bucket Shop, out of, Jersey that no one's heard of, that's going to, be trading in these names, that doesn't post collateral or, whatever it is.
Sure.
You can be conservative. And on top of that, you can not lend out a high percentage. There's a lot of things you can do to mitigate the risk. And you can stop it at any time, of course.
I'm curious, at the opening of this little idea, you mentioned you're not stupid enough to do it. What, this, sounds interesting.
We have enough ideas that we launch as funds where I'm like, this is a brilliant fund idea, and no one seems to agree with me. And this fund sits at $10 million. And so that's a real cost. But then again, I see funds launched and they go to $1 billion that I think are stupid as well. So who am I to know? I think someone will do this. And it's funny because there is a laundry list of very large failed ETF providers that, when I say very large, meaning they probably manage in the hundreds of billions elsewhere, and they don't know what to do. Like, are they going to launch another smart beta large cap value fund? I mean, come on. They've already missed the boat. They don't have any ideas. They're bankrupt as far as, a brand or what to put out. Here's an idea for you. So you guys run with it.
All right, there you go.
We'll sell you the domain if you want it. 2 more.
Quant cookbook.
This is fun. Not technically fintech, but it was inspired by some stats quant stuff. There was a 538 post, Nate Silver's site, on ranking video games, or not, board games by their quant ratings. And so we talked about Wirecutter, kind of does this curation of various sources. And so our idea was, there's an area everyone likes, probably the number one book selling category if you want to make big money in books. And ironically, it's probably self-help and weight loss and cooking. So the two are diametrically opposed. And we said, look, there's all these websites that have recipes, and if you and they have like thousands of reviews for many of these recipes, why not, curate them and find the highest rated ones? And granted, if it's a 5-star recipe with 5,000 reviews, chances are it's pretty good. So we wrote a post on the blog where we found, the 20 best recipes on the internet. And it was funny because a lot of these cooking websites are horribly designed. Like, you couldn't search them, you couldn't rank them, you couldn't do anything. You could find a recipe page for apple cobbler and it would have a rating, and that's it. Like, you couldn't go to anyway. So someone with some programming ability could write this cookbook, and it was interesting because a lot of the recipes are very comfort food. It's mac and cheese. Mm-hmm. It's the world's best lasagna.
Mashed potatoes.
Yeah. I mean, you're not getting sous vide pork chops with lemon rosemary, sauce. And so I was like, I'm going to cook some of these. And I cooked some and they're great. But it's an interesting idea for a cookbook. So if you decide, or a website, like there's a better recipe site out there that one could go source all the other recipe websites and just do a simple ranking of the world's best recipes.
You love ranking.
I wonder if that's because I don't like wasting time on nonsense. So here's a good example. How many restaurants do you go to where the food's just crap? Like, how does that restaurant not? I mean, I know your taste, so your bar is much lower. How did that restaurant? How's this crappy hamburger joint not go down the street to In-N-Out and Five Guys and 1,000 other good hamburgers and say, we're just going to copy what they do? And at least let's take Shake Shack's recipe. They just put out a cookbook and we'll do Shake Shack with our twists. Like, that's not that hard. Anyway, so the same thing with recipes. Like, why waste your time? And again, if there's a common theme to these ideas, that's probably it: curating and ranking. Mm-hmm. Because there's no need at this point to be cooking shitty recipes and listening to terrible podcasts.
Well,
we got any more?
On that note, last one. Yeah, Forever Fund.
By the way, and Jeff is skipping like 2 or 3 that he wants to run with that he thinks you people will steal and is too good of an idea to share. So blame Jeff for not giving you a couple of the best ones. Which one is this? Oh, Forever Fund. This was an idea. We spent a lot of time talking about investor behavior and hey, put your money really where your mouth is. If you really are a long-term investor, then act like it. So we said, what are the best ways we can behaviorally nudge people to do the right thing with investing? So they have our ETFs. They can sell them. They have a separate account. They can close it. There's no real barrier between them being stupid. And so one example was, I said, let's start a fund, and you could do it as a mutual fund, and say, all right, it's 0% fee. So we're not going to charge anything. And, we'll invest in our ETFs and other ETFs. So it'll be low cost, less than 50 bips. All in, give you a globally asset allocation portfolio. So kick-ass fund and asset allocation, low cost, tax efficient. However, we're going to implement both a penalty and a reward system. So the penalty is it's going to be a 10-year declining redemption fee. So year one, maybe it's 5% or 10%. Maybe it should be really just egregious. And it declines all the way to year 10 where it's 0. So if you hold the fund for 10 years, and maybe it's 5, I don't know, we'd figure it out. But 10 seems sufficiently long.
You would need it to be at least one business cycle, at least.
So 10 years, if you hold it for 10 years, there's no redemption fee. But people don't really respond. As I was brainstorming with Jason Zweig about this other day, and he said there was actually a fund that did a long lockup, and then it was very successful until 1999, 2000 happened. Everyone sued them. so this wouldn't have a lockup, but it would just say you're paying a fee on the way out. Tough.
Yeah.
But the beauty is, I would say, look, we're going to call this the irrationality dividend or the long-term thinking dividend or something, where we say everyone who paid that redemption fee for this year gets dividended to all the other investors in the fund as a bonus, right? Mm-hmm. So someone's short-term thinking sucks for them, but it's going to get dividended out to all the investors that stayed the course. Like, what a cool... So not only do you penalize people for acting stupid, you reward people for acting long-term.
I would love to see sort of the mind warfare of, let's say, two neighbors who both get into the fund. Things start getting a little south, and one neighbor comes over to the other, trying to get them to sell out of the fund.
I mean, there's got to be some potentially amazing ARB opportunities where, like, let's say you had another 2008, and the fund was at $1 billion, and then everyone panicked and sold, and it went down to like $300 million. But you have all these massive fees. Then if you're an investor, I mean, you have to get some huge dividend from sticking around.
Yeah.
Anyway, I like that idea. We have enough funds out there right now that are underwater. So when we hit, what's a good number? We'll launch this. Hit 5 billion, 10 billion.
Sure. Let's call it 10. All right, we initially had talked about doing some market commentary, but we're an hour and a half deep. Why don't we save that for maybe do another one later this week or throw another podcast out next week?
Great. Well, look, I mean, also, listeners, if you got any cool ideas that we haven't thought of, if they're really terrible, send them over to Jeff. If you want to be Jeff's assistant, send him an email, jr@CambriaInvestments.com or feedback@themebfabershow.com. Anything else, Jeff, think about?
Not on this one.
Great. Awesome. All right. Well, it was a lot of fun. I've run out of voice. Thanks for taking the time to listen today, you guys. Hey, please leave us a review. We've had 40,000 downloads an episode on average now, and like 100 of you have left a review. So that's like 0.01% of you. So get off your couch, 5 minutes. You don't even have to get off your couch. Just go to iTunes, leave a review. We read them all. So it's really thoughtful. We'd like it. There is going to be a lot of show notes for this episode. But always, you can find the rest of them too at mebfaber.com/podcast. You can subscribe to the show on iTunes. And thanks for listening, friends, and good investing. Today's podcast is sponsored by YCharts. YCharts is a web-based investing research platform that I've been subscribing to for years. In addition to providing overall market data, it offers investors powerful tools like stock and fund screening and charting analysis with Excel integrations. It's actually one of the few sites that calculates both shareholder yield as well as 10-year PE ratios for stocks, two factors that are notoriously hard to find elsewhere. The YCharts platform is fast, easy to use, and comes at a fraction of the price of larger institutional platforms. Plans start at just $200 a month, and if you visit go.ycharts.com/meb, you can access a free trial, and when you do, you'll receive up to $500 off an annual subscription. That's go.ycharts.com/meb.